Let's welcome in Ryan Patel, a global business executive known for being a key part of some great companies and the business growth at Pinkberry, Jamba Juice, and BJ's Restaurants. It's nice to see you. Thanks for being with us on a big day for a name like Shake Shack. What did you think first out of the gate? I mean, Danny Meyer has really been, he's sort of seen like Elon Musk, you know what I mean, for Tesla. He's really, everybody loves him, but the stock is getting hit today.
Well, and I think welcome to the stock market. When you start to become a small company and you're growing and you're scaling right at a pace that they have, you have an ability to continue growth. But they've been 200 plus stores, now 70 plus stores in international markets. Now you're welcome to being valued and judged by the market. And one of the key indicators is that comparable sales, that comp number declined. And so when that happens, as you know, it provides a kind of a red flag a little bit to Wall Street to say, well, you didn't grow your sales. What does that mean? And sometimes people, I don't want to say overreact, but there's a lot more questions now. I mean, their top line revenue was still there and it hit expectations for the analysts, but their existing sales took a little bit behind the hit.
And it's gotten a slew of price target cuts as well. I mean, I think that sometimes it's if you just sort of put out your earnings and then, the analysts come in, they might make a few adjustments, but having a slew of analysts price target cuts is not necessarily a great thing. And there they are. I mean, you could see there, Morgan Stanley brought it down to $76 from 84. We also see Stifel Nicolaus, $60 from 80, and there's SunTrust, 85 from 102. So there's the board of all the new price targets.
I mean, and they rechanged what they were expectation for Q4, so rightfully so our analysts were going to change. But think about this for a second, and you think about the long-term growth for what Shake Shack is going to do. I feel like they're going to do more international deals. They're going to be focusing on licensing deals, so that gets them less risk in doing corporate-owned stores. So they'll be able to get a check with low, with low investment, and they've been able to do it with great partners, especially in the Middle East that they have and in Asia. So if you start building that up, you're almost like a franchise model, and you still build to 20 to 30 plus stores in the U.S. if it's your own corporate model, and they have a different, set that up. And I think the other thing that they haven't really figured out yet is the delivery model. They just went to an exclusive partnership with Grubhub.
Yeah, that's what I was going to ask you about. But they said that it was a botched.
Yes.
It was a botched partnership with Grubhub. I mean, what went wrong?
Is there one company that who's done it right delivery yet?
Oh my gosh.
I mean, it is. I think I like the effort that they were trying to do. Like, all these partnerships didn't work. Let's pick one, and they still couldn't get it right. And I think, to me, there's a missed opportunity there. If they could fix, it's a revenue stream that I think that they're going to count on, they're going to need to do, and I think that's something that investors are going to want to see. Like, if they came back in next month, next quarter, and said they got a plus in the delivery business, right? Think about the potential that they could continue to go if they got it right. But that's not a good start to have that piece coming up now. Yeah,
and it dropped some of the other delivery services, including DoorDash and also Postmates and Caviar. So, they're trying to work with Grubhub, but I don't know. What about some of the other names in the space?
Yeah, you see. I mean, it was funny you mentioned that. Popeyes, not Popeye, but they had this kind of. Big thing about their chicken sandwich coming back, and people are waiting lines, and you think about that.
Amazing.
And you think about what that means from a top line perspective. Like, they didn't spend very much money on the marketing, and from a franchise perspective where they want happy franchisees and growth, that's a marketing place that people are waiting in lines for something like that, and they can come back into the space.
Do you have a quick thought on Wendy's or Papa John's, some of these names that'll be coming out with some earnings?
Yeah, I think Papa John's is very interesting to me because I think they've kind of made a little bit of a rebound in the last, last year or so, which is from a year ago, 2 years ago, is a different kind of mindset. So I'm excited to see what they're going to come out with.
And of course, McDonald's with the changing of the guard.
Yeah, and I think the board of directors moved very quickly on that to set the tone for the rest of, I think to set the tone on the policy-wise.
I did hear that he doesn't own one share of McDonald's. So maybe he needs to buy a few just so that he's involved, has his money where his mouth is. It's great to see you. Ryan Patel, thank you so much for being with us, Global Business Executive, as we took a nice look there at Shake Shack.